Understanding directional bias. When I say directional bias, I'm literally talking about in which way price is moving. And this is all based off of the daily time frame. We all know that price does not move in a straight line. In an uptrend, price will make higher highs and higher lows. And when it comes to a downtrend, price makes lower lows and lower highs. In an uptrend, price could make higher highs, consolidate, higher highs, consolidate, higher highs. And in a downtrend, price could make a low, consolidate, and then another low. What I just showed you now compared to what I just showed you before is exactly the same thing. Whether price is going to expand like this or retrace like this, the agenda is the same. There's going to be liquidity generated above these highs. There's going to be an accumulation of orders. Same thing here. There's going to be an accumulation of orders along the way down. So every single high price makes, there's going to be liquidity above every single one of these highs. And price is going to run past that, run past these highs and run at that liquidity on the top side. So oftentimes there might be a little dip before the rise. So where it just taps into this, taps into that liquidity, manipulates that low and then runs higher. It's the exact same thing happening here and the exact same thing happening on the downside. When price is moving higher, it's most likely going to either expand and consolidate or expand and retrace. But these two phases within this whole expansion, the agenda is the same thing. Price is generating liquidity to then run it later. So we take this liquidity, so there's money beneath here. The moment we drop beneath this low, we've taken that liquidity and then we run up higher to run out the liquidity on top. Same thing here, when price is dropping lower, it's most likely going to run out liquidity, some liquidity beneath these lows. So for example, this one right here, I know this chart's getting really messy, it runs it and then goes higher to run out all the rest of the liquidity above these highs. And then it's the exact same thing on the flip side. There's going to be liquidity beneath these lows. Price is most likely going to do something like this, run out liquidity above these highs. One of these highs, it could be all of them, it could be just some of them, and then run that liquidity beneath this low. It's the exact same thing here. Consolidate, consolidate, price might run higher first and then drop, taking out that liquidity on top and then taking out that liquidity on the bottom and then continuing its move down lower. So now you understand this. Price does not move in a straight line. There's oftentimes consolidation can take weeks, can take 2 weeks, 3 weeks sometimes. Or consolidation could be 1 day. All this is, like I said, is a generation of liquidity to run it later. Accumulating more orders. Same thing here. We're accumulating orders and we're generating liquidity to run it later. Now, when it comes to understanding the trend, like I said, price does not move in a straight line. So now this is Euro USD. When price is moving up higher, price is going to move higher. And then there's going to be a retracement here, some kind of retracement or accumulation. Price doesn't really retrace anyway, it just goes sideways. So in other words, this is accumulation of orders and then there's going to be another expansion. When price is on its way down, price is making lower lows, then we come up high, then we drop lower again, then we retrace, and then we drop lower again, and then we're having a retracement again. So like I said, price does not move in a straight line. What I used to do is when price was accumulating like this, I would always be expecting some kind of larger retracement, deeper. Oftentimes, price wouldn't even come back. Why? Because it didn't need to retrace because the agenda was complete, which was to accumulate orders and then take it higher again. Now, with this, you have to understand that price moves from a discount into a premium and then from a premium into a discount. So for example here, when price runs above these highs, this high over here, price is at a premium price. And then ideally, you want to see price retrace to equilibrium. And so when it retraces to equilibrium, roughly about 50%, let's go ahead and use this fib tool to go ahead and mark up where equilibrium is, or the halfway point of this whole push up higher. You would mark it up from high to low, and then you would expect price to at least get to a premium price. This one failed, but this is where you would expect price to get to a premium price. This is consolidation, so whenever price is consolidating, you don't expect it to get to 50%. It's just an accumulation of orders where it is. But when price is retracing, you want to see at least some kind of trade back down into a discounted price. And it's the same thing here. You want to see the exact same thing. So from this very highest point, which is one I'm marking up right here, and I'm marking up this low right there, you'd want to see price drop into a discounted price. So when it runs above this high again, that means all of this is premium action. It's at a premium. And then you want to see it drop down into a discounted price before it rises again. It failed to get back above the high and it crashed beneath these lows. Now Euro USD is at a discounted price. Then you'd want to see price get up into a premium price. And I know I've marked up from this high to this low. Ideally, it's this high to this low is our range. This is our low, this is our high. We drop beneath this low. So now Euro USD is at a discounted price. You would anticipate a move back higher into at least an equilibrium, ideally into a premium price before price drops. So from the highest point to this point here, the lowest point, let's go ahead and mark it up. You can see price trades beyond this level here. It trades beyond all of this. It trades beyond equilibrium, which is 50%, up into a premium price, which is all of this action up into here. This also helps with directional bias, because if you see price trading at a discounted price, you can't be looking to hold those sales for too long. Price will oftentimes turn around back up into a premium price before looking to go short again. And so this is exactly what is done. So you need to understand in which way the direction price is going. So for example, EURUSD is currently selling off. We've traded beneath this low, we've retraced up into a premium, and we traded beneath a low again. It's at a discounted price. So you're expecting a retracement. And then once it gets into a point where it's at equilibrium or higher, this is when you can start to expect price to turn around. So let's go ahead and move it to the most recent one now, because we traded beneath this low. We have our new range now, which is this high and potentially this low. So now we're going to go ahead and mark up where our equilibrium is. So you can see right now, let's go ahead and mark up so it's nice and neat right here. You can see we've traded up into equilibrium. This is good. This is where you want to see it retrace to minimum if it's not accumulating, if it's not consolidating. If it's retracing like it is now, this is a retracement. It's like an accumulation higher. That's just basically a retracement. It's like an accumulation higher in a sell. So now there's a few more things you can add onto this to understand that price is going to be going in a certain direction. One thing you can look at is looking at where the large plays are. So for example, the large plays would be a big push up higher, you get a small little sell off. Large push up higher and a small little sell off. Here to here, that's a big buying action, and we have small selling action. Once again, we have big buying action and we have small selling action again. So on all of this, big buy plays. This is how you know price is bullish, until it runs the low and then we start getting larger sell candles. This high to this low, large sell candle now. So in other words, where you're seeing the large plays is where most likely price is going to go to. So look at this again, large play to the downside, massive play to the downside again. So you're seeing all these different large plays to the downside. This is another large play, forgot to mention this one, but you can see there's a little interruption, there's a little buy candle in here, but really and truly it's just one play to the downside. So now you get large plays to the downside. So it's telling me that price wants to drop off. So that's another thing you can use. You can look at these large plays. Where are the large plays in the market? You can even use your ruler tool from the low to the high. You can see 193 pips, and this retracement or consolidation was 92 pips. Once again, let's go again from the low to the high to 185 pips. That's about 250 pips. When it comes to retracement, the retracement, if that was 250, the retracement was 160. That's smaller again. Then we get another massive move to the downside, 283 pips. This should also help you to know where price is going. So for me then, I'm looking at price dropping off, selling off, because the large plays are to the downside. Another thing you can use to help you with the directional bias is institutional order flow. Institutional order flow is all about in which way the banks are buying or selling. If you're bullish, whenever price drops into a sell candle, you want to see some kind of buying. So for example, this is a sell candle, a whole sell play down here. I'm going to go ahead and mark up the open and to the wick high, and then I'm going to expand it out to the right. And whenever price drops into the high to the open or into the sell candle really, then you want to see buying. And then once again, you see another sell candle in here. I'm going to mark up the very highest point to the lowest point, expand it out to the right. Now you can see whenever price drops into a sell candle, I want to see buying. And obviously this one failed to get to this high. So this here was telling us that institutional order flow was to the upside. But then price failed to get above this high. And when it failed to get above this high, that means then we're going to start to see whether institutional order flow switching too. And so all that literally means is whenever price gets up into a buy candle, you want to see selling. This is a whole massive buy candle up to the upside. So this whole candle here is a massive up close candle. So when price comes back up into the buy candle, you want to see selling. And all I've done now, I've marked up this whole buy candle. You don't necessarily want to see price be closing above the 50% mark of this whole upward play. Eventually, after price closed beneath this low, it then retraced up into it and then it dropped off. And then we can do the exact same thing here. Look at this again, another play to the upside from the low to the high. And then when price gets up into it again, so let's delete this one for now. EURUSD traded up higher when it was at a discounted price, came up into this whole buy play. Whenever price moves up higher into these buy plays here, you're seeing that drop off. And this is the beginning of this drop off. Price is rallied up higher, back up into this area here, and we're potentially dropping off and going for the downside. You can utilize all of those things to understand the direction of price. And one other thing we can use to understand directional bias, in other words, which way price is going, is looking at short-term highs on short-term lows. This is going to be something we cover deeper later on in the program, but for now, I'm going to give you guys a quick, brief example of how to use the short-term highs and short-term lows concepts to know where price is going to go. This candlestick here, this high, is a high between two lower highs. So in other words, this candlestick right here, the candlesticks beside it, both of them are lower than this one. It's a high between two lower highs. This low here is a short-term low. So that's a short-term high. This is a short-term low. A short-term low is a low between two higher lows. When price trades through a short-term high, this is often a sign that price wants to either retrace back up into the range or go up and make new highs. There was a short-term high here. What happened? Price rallied above the high and then we continued to push up higher. There was another short-term high here. Price rallied above the high and then we continued to push up higher. And each time, whenever price did this, price did not run through a short-term low. Why? Because these lows were being protected. So there's a short-term low right here, a low between two higher lows. There's another one here, a low between two higher lows. And we have another one right here, a low between two higher lows. So these lows are being protected and highs are being violated. This is a sign that price is pushing higher. So that just literally means then you can then further target these highs. Target all these different highs along the way because price is pushing up higher. On the flip side, you have a short-term low. So this is a short-term high. You can see price does not run above the high, but we have short-term lows. This is a short-term low. It's a low between two higher lows. Along the whole push up, price did not violate any one of these lows until when this happened right here. We violated this low, and then this was our early sign that price was going to turn around. And then eventually we got down to these lows where we were violating more short-term lows and we violated the main one, which was beneath this low right here. When price violates these short-term lows, oftentimes it will do it with a larger candlestick. And when it does with a larger candlestick, they will normally leave an area of inefficiency, which is also going to be something we talk about later on in the program, which is going to help you guys with your directional bias. So these areas of inefficiency from this low to this candlestick's high, there's uneven trading. That's what an inefficiency is. Some people know it as a fair value gap as well, or an imbalance. And then when you extend it out to the right, you can see when price gets to it, we see that drop off. Price drops off. And once again, look, when it runs out these short-term lows, oftentimes they do it with a larger candlestick, and oftentimes they'll leave an area of inefficiency where there's uneven trading. Once again, we're going to go ahead and mark that up as well from this low to this high, and we extend it out to the right, and you can see price then rallies up into it and it drops off. And then one more time, look at this, guys. Once again, look at another inefficiency here. When it runs out this short-term low here, a low between two higher lows, we'll go ahead and mark up the inefficiency over here. We trade beneath the low, but then the key thing here is what does price do when it gets to this level? Are we going to drop off for continuation, or are we going to close above this area here, the imbalance, which means we're going to retrace back up into the range?